Hello, 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 everyone. Mike Arnold here, co-founder of Training Partners, along with Bob Iacchino, who will be on shortly. So, good morning, Jake. Good morning, Davey. Buenos dias, Jacob. Good morning, Josh. Lily pullback and the old Crocs too. Are you trading Crocs? I've never owned a pair of Crocs, by the way. Good morning, Patrick. I gotta find out if Bob's owned a pair of Crocs. That would be funny seeing Bob in Crocs. Hey, Dr. M. Vic's up slightly. Hey, Davey and crew, thanks. Good morning, Connor. All right. We'll get to this in a second, but we had the initial and continuing jobless claims out. You know what? Let's just get through this. Please subscribe, ring that bell, and hit the like button. Longer subscribers, leave some comments after the live stream, and come back and like the videos and do what you need to do to keep this growing. I'm gonna get back and hit the magic Bob button. The magic Bob button, because the question of the day: have you ever owned a pair of Crocs?
No, I'm a believer that men wear shoes. That's it.
Oh, I know you're a sneakerhead, so.
Yeah, but I mean, they're shoes. I don't wear sandals. I don't wear flip flops. I don't wear Crocs. I wear shoes.
Well, I'm glad to hear that, Bob. I am very glad to hear you've never owned Crocs. So we're done for today. Bob's not owned
That's it.
Crocs. You can
I'm a
rally the
bearish.
market. Markets always go up. Bob doesn't own Crocs.
Everybody wants to know if I'm bearish or bullish all the time. I'm bearish Crocs.
You're bearish on Crocs. Okay. Well, we already had the initial jobless claims, continuing jobless claims come out. Continuing jobless claims, the magic number I'm watching is 1456,000. Because based off a percentage increase from the low print, that's been a very reliable recession indicator. So that's another one. We're climbing slowly. We're at 1416K. What's your take on the employment figures?
Yeah, actually, the 260 number is still respectable. And we keep in mind that the jobs data is lagging, but jobless claims data isn't really lagging. It shows you the trajectory. And a lot of people follow the continuing claims much more closely, as you said, than the initial claims. But this is the first time that the jobless claims, no, I'm sorry, this continues the trend of the jobless claims exceeding expectations. I think it's now 8 weeks in a row, and I'll say it's 11 weeks out of 13 that jobless claims has been worse than expected. So, um, it's a trend. There's no doubt it's a trend. It's not an indicator of tomorrow's number at all, but it's definitely a trend.
Any thoughts on BOE hike and their talk about 5 months of recession?
Yeah, so this is historic to me. First of all, it's the largest rate hike since 1997. That's the last time the Bank of England did 50 basis points. Um, it is it brings rates to an area that they haven't been since 2008. And I mean, it may have happened, but I've never seen a central banker say we're going into a recession because essentially he basically predicted that we're pushing the market into recession to get prices under control. So remember the ECB, the Bank of England, I'm not sure about the Bank of Canada. They don't have an employment mandate. They only have a price stability mandate. So they might have a little bit more leeway to say those kind of things than, for example, the Fed. The British pound fell on the news, and it's likely fell due to it rallied off the announcement, and then it fell on the prediction of a deep recession. So, but recessions are not the stock market. I mean, in general, stock market goes up during a recession. The only exception is when it's a recession combined with inflation or when there's stagflation. Stagflation is the only time equity markets don't perform to the positive during a recession. And that's what we may have now. We'll see.
Markets pretty mixed this morning pre-open. FOMC, the rate hike projection is still at that 25 basis point. Still with all this 50 to 75 basis point stress over the last few days, like the Fed speaker stressing it, that the market's still not buying it.
Yeah, I think that's really interesting. I mean, we're a ways off from this decision. So it's one of those things that usually converges as we get closer and closer to the decision. Um, But I'm telling you, like, my opinion is, as long as jobs, tomorrow will be a very interesting number. It'll be two things: the unemployment rate, because that'll provide cover for the Fed, and wages. We got to watch wages because we're seeing some. So in the ISM figures, the same thing has kind of developed in the non-manufacturing or in the manufacturing and ISM that we got for the U.S. It missed expectations, but the price index was way lower. Now, yesterday, we got the services ISM. U.S. is a service economy, and it exceeded expectations, and it exceeded the last print. So it's a very good number. But the price index dropped. Now, here's the funny part, and this is what I keep saying about inflation. The price index dropped. I'm going from memory. I don't think you have it up here, but I'm going from memory to 76. I want to say 76.2 from 80.1.
72.3.
72.3 from 80.1. It dropped from out of this world high to really, really, really high. And this is what I keep saying about the inflation. How you doing, Dr. M? This is what I keep hearing about seeing about with the inflation stuff is that, people talking about, okay, prices are starting to ease. We may have reached peak inflation. And I've said this before, and the CME group asked me to write an article about it. So I'll put out an article sometime in the next week or two. Prices are measured, both the PCE and the CPI, but I'm going to focus on the CPI because the data is easier to read. It's an index. So, for example, if 2 years ago you were paying $30,000 for a Ford Escape, okay, 2 years ago. Now, all of a sudden, that price goes to $60,000, right? It just doubles. And everybody's like, oh my God, the price of Ford Escapes are going crazy, right? And then it falls by, I don't know, what did it fall by, Mike? 10%, 20%? Pick a number, doesn't matter. Let's just say it drops down to $45,000, right? The new price is $45,000. It's still $15,000 higher than the $30,000 from before. That's what needs to happen. Now, what's going to happen in the first batch of CPI numbers that people kind of get excited about is the plus 9.1% year over year will hit something called a base effect, where the year over year number kind of stays steady, and then the new number moves only a little bit higher. And then that'll show maybe a 3% year over year inflation rate or a 6% or a 5%, whatever. It'll be much, much lower, but you'll still be coming off that higher base. So what's that example like? Ford Escapes at $30,000. 2 years later, it's at $60,000. Now, 1 year later, it's at $62,000. And everybody's like, okay, at least it's not going up 100% anymore. It's still going up. It's still $62,000 versus the old price of $30,000. And even though it's growing at a smaller level, it's still growing in price. And that's what's going to happen in CPI for the foreseeable future. So that means wages are not going lower. Okay, that means people will not accept a pay cut because inflation is growing at a slower rate. So when you look at it from that perspective, and you see the price component of the services PMI fall from a high level to a very high level. I'm sorry, from a very high level to an even high to a high level. That's not necessarily the good. It's good news. Don't get me wrong, but it's not the good news to be crowing about. It's still at a wildly expansionary level. All the ISM numbers are the same. 50 means expansion. Contraction. It's the fulcrum between expansion and contraction. So in order to see prices actually falling, the price index has to go to 49.9 or lower. So prices are still expanding. So that's the problem I have with this particular recession, because that's the time when equities don't perform, because the price increases and the wage increases dig into profits over time. Didn't happen in this particular earnings report. The Q2 earnings have been pretty good. I'll get my fact set report after the close on Friday. I can even review that report if you guys want Saturday morning and send it to Mike or something. He can post it. But also, I'm committed to doing that crude oil. I think it was, I don't remember if it was Sterling or somebody asked for kind of a crude oil fundamental breakdown.
Yep.
I'm committed to doing that. I just don't know when I'm going to do it, but I'll find time to do it.
Here's another, I mean, this chart's been out for a few days now, but I always thought this was interesting too from Bank of America showing headline, even if you come for the essentially the rest of the year at CPI month over month, just 0%,
Yeah.
it only drops to 6.3.
Right, which is massive. And look where it is versus, let's say, April 2021.
Yeah.
By the way, a lot of people, like a lot of Trump MAGA people, will point to where it was uh, before Biden got elected. I don't give a shit about that. I don't. I just want to continue to point out to people that the only time equities don't perform in a recession is when there's um, this sort of element of inflation that isn't going away. And that right there shows that, yeah, even at zero point 0.0, which is not going to happen, I think it's more likely to get a zero point 0.2. And that puts the year over year effects at 7.9.
And that's for each month going forward the rest of the year.
Yeah. Now, Jim Bianco on our podcast, the Futures Edge podcast, which is on this channel. Okay. You could find the Jim Bianco episode by going through the video archive. He said in there that we have to average 0.2% for somewhere in the range of 18 to 24 months in order to get inflation down to like 3% a year on a year over year basis. So 0.2 over like 2 years. I forget the exact thing he said, but like I said, you can go back and watch it if you're interested in it. By the way, I'm on this morning because I'm not going to be on this afternoon. I want to let everybody know. So you can all show up. The people who hate me can start coming back.
Well, nobody's going to tune in then this afternoon, Bob.
Just letting them know.
It's just going to be me talking to myself.
I doubt that, but sure.
Oh. Hold on. We got options 22. Good morning. Dr. M says hi, Bob. Again, Rams of Fall. Good morning. Lauren, good morning. Did I miss anybody? I think Anissa, good morning. Oh boy, we still have the nothing is bearish. Nothing. That's the way pretty much everything's taken with the short squeeze index up massively. What's your take still on this yield curve? And then I'll get to some other stuff. The yield curve just keeps, the
yield curve is being brutalized.
Yeah, this is getting to insane levels.
Yeah, so essentially the yield curve, the 2s, 10s yield curve, there's only been one false signal since going back to like, you know what, don't quote me on when, but the last 11 recessions have been, 10 of them have been predicted by the yield curve. And over those last 11 inversion of the yield curve, there was actually 12 inversions, but one of them was a false signal. I believe that was 1998, but don't quote me on that. I think 1998, 2s, 10s inverted, and we did not get a recession, but all the others have been predicted. If you look at where the 2s, 10s spread was, let's just go, I don't know, pick the end of a month and a year, Mike. I don't care.
What, this year?
Or half of last year. We don't want to go back too far. It's ridiculous. How about February?
February of this year.
39 basis points positive. It's 38 basis points negative right now.
I mean, this is just an insane move.
It was positive 120 June 30th of 2021. 120 basis points. And it's negative 38 now. From June 14th of this year to today, it's 42 basis points have been lost on the 2s, 10s spread. 42 basis points. So June 14th, it was positive. And it's 42 basis points lower. It's getting brutalized. And I don't want to say that the depths of the 2s, 10s inversion makes it a more likely recession. I don't really want to say that because I didn't go back and look at 1998 and see what the false signal entailed. I may do that if I get time, but I promised Sterling a crude oil video. I think it was Sterling. Was that Sterling, Mike? I don't know. It doesn't matter. Don't get upset with me. But yeah, so yeah, that's it.
Well, here's that 98 210 inversion. A little brief blip.
Where is it?
Right here. See?
Oh, okay.
And
So
here was the here was the .com, tip over point. Here
look at
was the
1987.
'07, going into the massive '08, '09 dip.
So the twos, tens inversion right now is reaching the levels of what's
It's
that? Is that
it's exceeded what we hit in 2007. It's closing in on the lows of 2000, and the last time it was this low before that was '89 before the '91 recession.
yeah, almost brutal.
So yeah, this is getting absolutely brutalized, and I think there was a little possible false signal in August of 19. Uh,
Mm.
real quick blip, but other than that, this is. But we'll
Are
just
those
ignore that
those
too.
those a closing basis, Mike?
What was that?
Are those prices you just set up? Are those on a closing basis, or are
That's on
those
a monthly closing basis.
okay?
So that's not the absolute lows, but I mean the
No, but I
monthly
would
close.
absolutely call that a false signal if we closed negative.
I don't. I mean, I'd have to look at the close on the monthly, and this is based off the also the this isn't the official ones. This is a CFD, so there might not have been, but it says a close of 0.009%
Yeah.
negative. Who knows? I mean, the bigger one was back in '08, but this is. I mean, you're not this. You can't shrug off this as there was a false. It just dipped below there for a couple hours.
Right. Right.
I mean, the closing low on this platform for back in the 2000 was the close was negative 46.9%, and we're right now at 38.5. So, oh well. But we're the only. Are we still going to have a soft landing? That's all I want to know.
Um, I'm leaning a little bit towards it, but one of the things that gives me pause is the twos tens. Um, because it's the NBER that is calling recession. So I've said this before, and this is another Jim Bianco quote. We've had recessions without two consecutive quarters of negative growth, but we've never had two consecutive quarters of growth, negative growth, that have not led to a recession. So that's never happened. This would be the first time. And by the way, we're going to get two more GDP revisions, and it's only zero point 0.9. So is it possible that it goes to 0.0? Sure. I mean, it's the government revising statistics. That can happen.
Real
But
quick,
yeah,
real quick, Bob. Why is crude oil down big? Are we in a recession? I'm confused. If we are in a recession, are people will not buy crude? That's why the price is falling, or what?
well, it's a couple of things. Number one, obviously, OPEC raised production yesterday. They raised their production targets by 100,000 barrels a day. Um, somebody I respect a lot, who is she's the bureau chief for Energy Intel. Her name escapes me right now, but I read her Twitter all the time. She put a quote on there: "How do you do nothing without appearing to do nothing? By increasing production by 100,000 barrels." So that didn't really hit the market much, but what did hit the market is a drop in actual consumption of gasoline. So in the month of July, we used less gasoline than we did in July 2021. So that combined with, hey, look at it from this perspective, Dream. The UK EC or the UK central bank just predicted a deep recession. They will not take vacations in a deep recession, okay, which is jet fuel. They will not take car vacations, which is auto fuel. People will lose their jobs and won't be driving to jobs, which is less consumption. And not only that, but August is pretty much the last month of the summer driving season. And Mike, will you pull up a seasonality chart? Do you know where to get it? Just
Uh,
type into one of the search engines, whichever one you use. I hope it's DuckDuckGo.
it is.
Crude oil seasonality equity clock. And you'll get their website, which will put the crude oil seasonals chart up.
Hold on. Do you want one?
Seasonality is going to start to weigh on the price of crude oil as well. It'll be the very first thing that comes up. Or, well, it's Equity Clock is the name of the company.
Which chart do you want? From who?
Crude oil seasonality from Equity Clock.
All right, hold on. Here it is.
All right, so you can see. So this is 20 to 30 years of data, depending on the commodity. And you can see that the seasonal strength continues through August and then rises up to about the end of September. Now, remember, this is 20 to 30 years of data. Okay, there's been several times where the summer driving season, and if you go back and look at individual years, you'll see that going into a recession is when we peak more into August than into September. September is generally one of the best weather months in the cold weather cities like Chicago. I got married September 1st because it was one of the only months we could rely on the weather, right? So there's usually a last desperate gasp around Labor Day. Is it Labor Day or Memorial Day, September?
Labor Day.
Labor Day, to go take one more trip, and there's this little spike in demand. Um, but the seasonals will stop being a tailwind for crude, and we've already got a drop in demand. So a lot of people are predicting that Labor Day trip for a lot of people is not going to happen, and we're not going to get that spike into September. So those are the reasons I have.
All right. Well, there we go. Covered a lot of ground this morning.
Hey, Mike, real quick, Lauren's asking about the EVs. Not yet, but there has been a massive spike in hybrid vehicles. The EVs haven't done as well, but there's been a massive spike in hybrid vehicles, and there's now a shortage of those vehicles. So it would have a mild effect, but not enough to drop crude oil from where it has recently gone. Hybrids have been bigger sellers than EVs because of availability and because of the flexibility. And I would argue, after I read Doomberg's plan for energy, that hybrids are a much better idea than fully electric vehicles. So you might see that continue, but that also takes less demand per vehicle for gasoline, but probably reduces more overall demand. So there's probably a small effect from it, Lauren, but not a massive one yet.
All right. Thank you. Thank you, Bob. I'm going to get to a couple key levels going into the open, and we'll see you again then next week.
All right. See you next week, guys.
Bye.
Hey, I might come on Friday morning after non-farm.
Sure. You're always welcome. Hey, Bob might be here tomorrow morning then.
I'll talk to you later.
Don't wear your Crocs.
See you guys.
See ya. All right, real quick, everyone, because the open's like coming up quickly, but I just want you to get Bob's take when he can get on here. Again, he won't be here this afternoon. 41.48 is the only thing that tips me short-term bearish this morning. 41.37, 41.32, 41.26, that short-term. More longer-term, I needed to get back below essentially 40.89, 40.90 level. I updated a significant level on the chart. It's 41.70. We break above there. 41.81 is a minor stop reduction. 41.92 to 4,200 is the major next target on the break. There was no double top in the NASDAQ that extended too far, but I am watching this little base for a breakdown. Again, coming up real close to that next target, this 13,360. The area I'm watching for the breakdown is about 13,232. And next major target, we'll have to update this again, but next major target is until 13,523. You can always use your short-term harmonics. We don't have a long-term pausing bar. The Dow, this is a double, but that does not trigger until below 32,350. So that's the only thing that tips me short-term bearish besides a little breakdown play on the open. Notes, by the way, this is a little triggered inverse head and shoulders for anybody who's wondering. That's why I have this levels on here. So we're trying to put in the short-term bounce pattern. Remember, there was the aggressive percent B buy on the dip yesterday. 120.31, 120.08, 121.08, 121.17 are the targets. The stop level would not be back until you get on a closing basis below 119.24. That's what I'm keying off of on the open. Dollar index, real quick. Dollar index still after triggering the buy setup a couple days ago, just basing sideways, so not much to do there. VIX just slightly up this morning, but not much there. So we'll leave it as that. A little quicker recap today. Tesla, let's just peek at Tesla. There is a potential double on Tesla. It is sloppy on the shorter time frames, but with this gap up, especially if we hit this 90, 955, that would be invalidated, and that would only trigger on a close below 878. So that's where we sit. Potential double top on S&P 500 daily. This extended too far up, I believe. I'll double check that later. I think that extended too far up. But again, you're going to watch this key pivot low from the 2nd of August anyways, because the target would be back down to this 4020 to about 4003. That would be the target into that clear path move if that does trigger. So you can just use that if you have the bigger rollover play below the low of the 2nd of August. All right, great. Everybody get ready. Open right now. So I will talk to everyone after the close today. Good trading. If you don't have anything to do, sit on your hands and don't put money at risk when you don't have setups. Bye for now.